Hi, good morning, everyone. Apologies for the couple of delayed minute start. My name is Ben Cardos. I'm the digital content and engagement specialist here at Monmouth Ocean Regional Realtors, and today I'm joined by Chris Whalen, CPA. We're welcome to Tax Prep 101. As you all know, you are in listen only mode, so there's no webcam, there's no chat function, but you should see in the top corner of your screen a speech bubble with a question mark in it. Make sure you send all your questions and comments over through that. That's how I'll be directing them over to Chris. So anything you might have that you want to say, definitely put it in there. Just that way, everyone, I know everyone has seen it. Can you all just quickly pop in there and say good morning, hi? Let me know what you're drinking. If you're drinking any coffee, if you've got any donuts, put it in that question box, just so I know that y'all can see it. Then perfect. Everyone's saying good morning. Awesome. All right. So, with that, I'm going to pass the baton over to you, Chris, and I will be in between coming through in and out with questions as needed.
Can you hear me okay?
Yes, we can hear you.
All right, great. Well, good morning, everybody, and welcome, and thank you for participating today. As everybody probably knows by now, I'm Chris Whalen, CPA, but got to do some housekeeping first. We know the rules about cell phones. I always say everyone tells you to turn them off, but I have different rules. I usually say turn your rings up loud enough so you can hear them, because any call you get is much more important than anything I'm saying right now. And please interrupt me with questions. I never turn my phone off, but don't tell anybody that. It could be money on the phone. Yeah. So we have a full service CPA firm here, a good staff, a good team. We're business and individual tax experts. We have a lot of years experience as a licensed CPA. We always give a free consultation or review of a prior year or answer any questions you might have or concerns with some other return that was prepared by somebody else. So at the end of this, if anyone can email me, I'll send the full color PDF of all these slides instead of having to do a screenshot. So just send me a quick email and I'll get them out to you the same day. And it's always good to subscribe to my blog. It's really good information. It's good tax or business advice, good tax research. It's never selling. So a lot of realtors are subscribers. They really like it. Oh, so I always say we're gonna have questions and answers, Q&A throughout. Hopefully, I'll give you so much A, there's be very little Q at the end or during. But please, if you guys can send a message to the host, and he'll ask me during the stream here. Correct?
Yes.
All right, great. So let's go over some tax changes for the new this year. Some important things to note, like the child tax credit. The important change to this is that your minor child, must be under 17 at the end of the tax year in order to, so you have to be 16 or less by December 31st. The total tax credit is possible is 3,600 per child. But you're not eligible if you're single and you make more than 200,000 or married, you make more than 400,000, you wouldn't be eligible. But a lot of people miss this who do their own taxes. Make sure when you go into your tax system that you make sure that the birthdays are correct because I see a lot of self-prepared returns that miss this. And that's a lot of money to miss. And if you have a parent that's living with you, you can get a $500 credit for that, or a brother or sister, someone who's a dependent of yours. Don't forget to include them because that $500 is good money and you don't want to miss it. Retirement plan changes. I always talk about SEP IRAs and retirement plans for us, the self-employed people. And a lot of realtors don't know that you can put away for your retirement beyond a regular IRA. There's something called the simplified employee pension. And if you look at these numbers, is you could put away a lot of money. What's good about this, everyone, is that you can take it as a full deduction. And then so it's your money that's going away for the future. And you get a tax deduction right now. It's one of the best deductions to consider to save for your retirement. And I always urge everyone when you get your taxes done, a lot of realtors do a Schedule C. Your preparer should calculate what your maximum SEP would be. And here are some limits. There are some realtors that have a spouse that works a job. Here are some limits for them, regular IRA limits. So remember, keep in mind these are all deductible now, but it's your money that's going away. So to get a deduction for your own money is still a great advantage. Here's some 401k numbers also. Everyone wants to know. I get this question also about gifts. So usually, if you give a gift to somebody, the person giving the gift is usually they have to pay tax on that. People don't know that. So if I gave you $100,000, there's a gift tax on that. Remember, the person receiving the gift doesn't pay any tax. They don't have to put it on their tax return at all. It's always the donor, the person giving the gift. So, but the IRS has a threshold here. In 2025, you can give $19,000 to somebody and not have to do any paperwork. But even if you give more than that, there is a gift tax. But we can do a form to make it not taxable. So this is good for people who grandparents they want to gift a house or gift something to their grandchildren, but they're afraid there's going to be a tax if it's over 19,000. But that's not true. So we can gift things while we're alive and still not pay any gift tax. So yeah, everyone can reach out to me about this. It's a very important. People don't know a lot about this, and it's better to not wait till you pass away to be giving gifts to your heirs. It's a really good option. Now, a health savings account. I want to go over this. A lot of people don't know about this. So many of us have out of pocket expenses for medical, for testing, for copays, for scans, whatever it might be. And so some of a health savings account will allow you to put money in this account for the future to use for medical, and you get to deduct it this year. So it's like a little bank account, but it's if you use it for medical later, it's not taxable to you. And so a lot of us have a lot of high deductible plans today. So imagine you could have a high deductible plan, you put out $8,000, but what if we could deduct that on our taxes? So here, for example, if you're a family, you can put away 8,550, and in any given year, you can spend 16,600 if you have it in there for your family. So we deduct the 8,550, say for 25, if you're a family, and then we can use that whenever we like. So that's a big savings of tax dollars on the 8,550. So if you don't have an HSA and you do have some out-of-pocket expenses, please look into it. Other thing here we're talking about is the earned income credit. Now, real estate, as you know, realtors have variable income year over year. Sometimes you have high, sometimes you have low income. So in this case, you want to see if you're eligible for the earned income credit. Because if you're having a low year, you might be at the income threshold to actually get the earned income credit, even on top of the child tax credit. Again, so it's important to take your time, especially some realtors have good years and bad years. The lower your income, always have it in your mind that you could have some really good credits that you could now get from the government. Very important. Now, a Schedule C. Now, all sole proprietors and sole member LLC owners file a Schedule C to report their business income. You all know that. This form gets filed inside of your 1040. So that's what a Schedule C looks like for the new people. This is what a sole member LLC or a sole proprietor files. And for many years, that's how realtors had to file. So this is what it looks like. Simply a profit and loss from your real estate business. So for decades, this was the only option for New Jersey realtors to file. Many realtors have been filing S corps, but that was an error. Only until recently could you file an S corp. Now it's finally legal. So now for people that are making a certain amount of income, as your income climbs, you may want to file an S corp instead of being a sole proprietor. That's all a separate conversation to have with me. So a sole member, this is very important. Many people think that if I form an LLC, I get additional deductions, and that's not true. It files the same exact way as a sole proprietor on a Schedule C, like I just showed you. There is no tax benefit. If you became an S corp, there could be, but making an LLC does not give you any extra tax benefit at all. It's the same exact tax, whether you're a sole proprietor by yourself in your name or you have an LLC name. An S corp may give you tax benefits, but that's a separate detailed discussion. In short, S corps can help save on the self-employment taxes or FICA. So if you start making over 60 or 70,000 net in an average per year, then it really could be worth doing an S corp instead. So let me know if you have any questions about that, and I will, like I said, I could definitely help answer those today. Now, everyone on the call here probably is covered by their brokers, E&O insurance, and always make sure that you annually check to make sure that it's in good standing. I'm not attacking any brokers here, but remember that you're out in the field working, and you're assuming that the E&O is paid up to date and it's covered. The coverage is correct. So make sure that the broker, at least when he or she renews it, you guys get alerted that the E&O is renewed for another year. Always good to have in your file for your own liability sake. All right, here we go. I know this sounds boring, but it's going to be very exciting. I promise. Now, I know the Monmouth and Ocean County realtors always keep their business checking separate from their personal checking. So there's no one in the audience today that commingles their business and personal records, correct? Of course, I'm kidding. It's very, very important that if you are commingling your business and personal in one checkbook, I strongly urge you to get a separate checking account in your name and start using that as an exclusive for business. Income comes in, expenses go out, the net money left goes into your personal to pay the personal bills. The reason why I say this is because under audit, one of the main things the IRS wants to see are the business bank accounts. And if I have everything commingled, I need to give them all of your personal statements because they include the business. So please consider getting a separate account. It makes it the other thing is when you commingle things, it's hard to account for correctly. Whenever I have an individual who's given me accounting or income statements that from a commingled account, they're always missing something. Whereas if you have a separate checking account, everything you spend is business. So it's easy to know and reconcile that you've taken every expense. Hope that makes sense. So people ask me, what can we deduct? Well, any payment that you make that relates to your business can be deducted. Don't limit yourself. You might be the first person to take such an expense, but if you know there's a business reason and you know you have a receipt for it that you paid, then don't ever be afraid to take that expense. Now, some things are a blend of personal and business. So you pay with two payments each month. Like, for example, on my American Express card, I download the little spreadsheet every month and I make two columns of business or personal. I total them up, make sure it totals my balance due, and I make two payments, one from my personal account, one from my business. So it's a perfect way to segregate even on a credit card. Like, what if you have a cell phone? Like, I have some of my children on my cell plan. So I have three that aren't business. So I pay a quarter of it with my business and three quarters with my personal. Easy Pass, another example. Credit card charges, like we talked about. So there's all tricks that we can use to make sure we're working quickly, but we're gathering all the information in detail that we need. So this is important. When in doubt, pay all expenses that you feel are business or even partially business related out of your business account, because then at tax time, we can more easily discuss it. And you might have, like, for example, if you're going to do a spreadsheet of your accounting, you can highlight those in a yellow color. And I could easily see and help you with it during the year at the year end. So remember, anything that's even partly related, put through the business account so to make sure we don't miss it at year end. If you're paying things with a personal debit and a personal checking, sometimes it's missed at the year end. I have a comprehensive list in my blog that I can send to the contact here. I can email you. It's a comprehensive. So it looks like this. This is only a very small part of it, but it's a really good detailed listing of all the expenses by category you might be able to take. This really can give you confidence, but also give you good ideas of things you might be missing. So make sure you email me and I'll send that to you right away. But don't limit yourself. Almost everything business related can be taken on your tax return. Never be afraid to take a legit deduction. Remember, the IRS, people often think of them as like the Tony Soprano collection division, but of course that exists, but the majority of the IRS agents I deal with are geeky OCD people that just are into compliance with a big bully behind them. So if I've never had an IRS agent in my whole career that's going after money. They want to make sure you're neat and organized and have support in a certain way. So if you know you've paid a certain amount of money, maybe it seems like a high amount of money. Maybe it's a category that no one really is using yet. will still have confidence to take that. It's very important. Next question. Do I need to pay estimated taxes? Well, that's a good question. Most realtors do, unless they have a spouse that has enough withholding on the tax return to make up for their tax, right? So we have a couple of questions we can ask. Did you owe taxes with last year's tax returns? In 23, did you owe money? Then if so, you probably should have had estimates set up. Remember, those are quarterly payments that have to be made. When you're a self-employed person, you can't wait till April 15th because then you're very late. The next one, did you earn more money than last year? So in 23, you didn't have any taxes due or didn't have any estimates to pay. Oh, but this year you're doing much better in 24. During the year, we should have been talking about what you might need to pay. So if any of these two things are true, most likely, yes, you might have an estimate obligation. Remember, you cannot wait till April 15th to pay your taxes when you're self-employed. Avoid penalties, pay quarterly. Now, I know that just to talk about this for a minute, I know realtors have money that comes in sporadically. And so you say, well, I can't pay quarterly estimates, especially the April estimate, because usually the winter is pretty slow. But when you get paid, we should be talking about paying money out of that commission check. That's when you have the money, and that's when you're obligated to pay. So you might not get a commission check till August, so you don't have to pay the April or June estimate. But when you get the money in August, just for yourself to budget and prepare, we need to talk about how much to put away for of that check and not wait till April because the penalties could be pretty high. So please think about that when you get paid, that we need to possibly pay estimates. Right here. Usually with my clients, no matter what, realtors, lawyers, doctors, at the end of August, they usually compile all their accounting as if we're doing a tax return, and then we could do a projection for you to see where you are. So that really makes it there's no surprise then. I strongly urge you get this done. We don't want to be surprised at tax time. Has anyone in the audience ever been surprised with a large tax bill? Most of us have, and that's not necessary with the proper planning. I don't like surprises. People ask me often, how often to keep our records? Well, 7 years is the term, but it's only for tax supporting documents. So anything you've used on a tax return, W-2, checking accounts for business, credit cards, receipts, all of that has to be saved for 7 years if it relates to a tax preparation. Home office deduction. Now, please don't be afraid to take this. Most small business owners have a home office, and realtors, your office is your home. So once you leave that office and walk out your front door, then your mileage starts then, for example. Realtors don't work in their broker's office. Your home office is your main office, and you happen to go to your broker's office to, do phone work and other things and have meetings. So this does not trigger an audit. There's a lot of business owners, including realtors, and they're afraid to take this because they think it triggers an audit, and that's a fallacy. That doesn't happen.
Chris, we
And
got a
this does
question
not.
coming in.
Oh, sure.
So sorry.
And I'm
Someone wanted to know if I'm able to make a full payment on the April 15th deadline, do I still get penalized for not making quarterly payments?
Yes, the money is due quarterly when you're self-employed.
Thank you. That was the only one we had right now.
All right, great. So there's also a worry. People say, oh, if you take a home office, it's going to reduce the basis of your home and you're going to have a gain when you sell. That's only if you take depreciation within the home office, and most people don't. So there's no worry when you could take a home office for 10 years and not have any gain to worry about when you sell. So this is a very important deduction. Everyone has it. It's normal. It almost looks abnormal for a realtor not to have it. So just you have to make sure your tax return reflects a home office deduction. And I can send you a good worksheet for the home office deduction to accumulate your information for your home. Remember, when you're doing home office, you don't have it's not just the little space you work in. It's also so if you own a home, you got to give me a total of your maintenance, your lawn care, any improvements, because we get to take a prorated portion of that on your tax return. And remember, let's say you have a two-bedroom apartment and one bedroom is your office. Anything you do within that room is 100% deductible because that's your office. It's not prorated. So remember that if you put floor coverings, wall coverings, desks, computers, blinds on the windows, anything, like bring in heaters, whatever you might do within that space, that's 100% deductible. And anyone can text me and ask me because I got questions like this. So I'm looking to, like, this presentation is looking to maximize your tax deductions and minimize your penalties and just give you confidence to do what you need to be doing to minimize your tax. There's also a safe harbor home office, meaning you don't even really have to accumulate any information. We can get you a $1,500 deduction pretty in a pretty straightforward way. So at least take that. A lot of us will have more than that if we did the work to accumulate the data. But the safe harbor is great. It's $1,500 for a lot of you. It could save you $400 or $500 in tax, and it's relatively simple. So if your preparer is not doing it, make sure they at least do the safe harbor, please.
We got another question that just came in, which is how do I find out an estimate to send in quarterly? Should I just talk to my accountant?
Well, this is how estimates work. So let's say that I had done your 23 tax return in February of 24, and you owed about $10,000 in tax. So the rule would be, simple rule is, okay, you need to pay 2,500 a quarter to stay in the safe harbor for estimates, no penalty, right? So you'd pay 2,500 April, June, September, January. So that's the simple way. Now, what we normally do is, for realtors especially, they're very afraid to pay estimates. So that's why, but for realtors, what I would normally do, say, okay, Joan, I'm looking at your taxes that you owed, and it's about 18% for federal and 4% for New Jersey. So instead of doing quarterly, so let's say Joan had, like we talked before, has a check for 100,000 in August. We've paid no estimates yet. I'm going to apply. I'm going to take part of that 100,000, pay 18,000 for federal and 4,000 for New Jersey at that time. So Joan would call me or send, like, they the realtor clients always send me their commission checks. I'm getting them all the time, and I send them back what they should pay and where the websites to pay. So realtors, if you pay when you get, if you, even if it's December, let's say you get one check in December for $100,000, you don't owe any money until then, but you do owe it then. So you don't have to pay any of the other estimates. It's when the money's accepted. So you want to make sure you know what your rates are from your preparer to say, listen, how much do I have to pay in estimates based on the gross commission check? And I could also help. Was that clear? Did that help?
Yes, that did. Thank you.
And a lot of us still write checks. I know this is taking a little while, but all this important information. If you write checks, not just a direct debit, not just a credit card charge, if you write checks, then that's the receipt for that expense. So if you went online and you paid for your Verizon bill with a direct debit, that direct debit information on the statement and your invoice is going to be acceptable. But if you wrote a check for that, that check is vital. Even if I have the Verizon bill, they want that canceled check. So I know we're not writing that many checks anymore, but some people, I still do sometimes. So we want to make sure on our bank statements for the business that they're giving us the check images on the white sheets that come with the downloadable statement. We don't want to say they're in a vault. We're going to get them because they only last for maybe 90 days. So you want to make sure no matter what, you have a good front of the check and back if you can get it of each check you write, because that's one of the most important parts of your support for those expenses. Let's talk about auto expenses, which there's a lot of confusion in. I think we're not going to be as confused when this is done. Now, mileage versus actual expenses is what this is talking about. Remember, usually this is a rule. The higher your mileage, usually the mileage method is better. So most of my realtors are using the mileage method because they're well over sometimes 15 or 20,000 a year. Now, this is very important. In the first year that you own a car or put it in service, you have to choose what method you're going to use. So in the first year, we sit down, we look at all the expenses that you had versus the mileage. We compare that and we decide what's going to be better going forward. Because so let's say you've decided on the mileage method instead of actual expenses. Well, then what happens is in 5 years from now, with the same car, if you need a transmission, I can't suddenly take that transmission expense. But believe me, the mileage method is definitely a money maker. If you hold on to a car and keep it. If you're going through cars once every 2 years, not as much because then you're paying for another car. But if you have a car for 5 or 6 years, and you're driving 15 or 20,000 a year, the mileage method is going to save you much more tax in the long run. Right, like I said, you must elect this and use it forever for that car as you place one in service. Leased cars can also use the mileage method. So that's also a mistake. People think I'm leasing. I'm just going to take my lease payment, my gas, my insurance, registration, maintenance. But that could be a mistake because the high mileage, you can still do better. Now, mileage logs are required with both, which we're going to go over in a minute. And remember, this is very important. Remember, tolls and parking are not auto expense. They're a separate expense. So a lot of people, when they use the mileage method, they think their easy pass is included with that already, but it's not. So make sure no matter how you expense your car, the easy pass and parking are separate because a lot of people miss that deduction. Here are the mileage rates for 24 and 25. As you can see, if we have 30,000 miles at 70 cents, that, it's going to give us a $21,000 deduction, which is going to far exceed actual expenses. Right. So many of us don't keep our daily travel. I know, and that's not just realtors, but it's a big pain in the neck. And it's a lot of people give estimates to their account at the end of the year. Oh, I think I did 25,000. Right. But this is the important point. The IRS, the auto deduction is one of the biggest ones for realtors, for most businesses. So this is something the IRS likes to sort of pick on. They like to send you a letter to well, send us the details of your auto. And so if you don't have everything right, they're going to deny it and add it back and charge you tax penalty and interest. So we have to be prepared if you get such a letter, because most of us are not prepared. So what do? We need to maintain adequate records, but I try to come up with a system to help to make it not too onerous for you. So what are the basic rules? No estimates allowed. Very important. If the IRS sees an estimate, they're going to automatically add it back. They want the exact mileage only. They want each trip itemized and the business reason listed. They want it totaled annually, the mileage, total miles and business miles. Go back. So taking a look at this, it seems like a lot. Each trip itemized, but I have ways that we can do it that we can live within the rules and we can still not take too much time. So what can you do to comply? Well, there's mileage apps, Mile IQ. I suggest using those because that's part of the puzzle. If you're out every time you stop the car, it'll beep at you and say business, personal, swipe right or left. That's something we all can do. I highly recommend it. So that's going to show the mileage for business that day or that trip. That's great, but it's not enough. You want to use your calendar. Along with this, most of us are putting our appointments down where we're going. So let's say you're showing me a house tomorrow. We're four houses. I'd say 10 a.m. Chris Whalen, uh, client, and type in the notes area or description all the addresses you're going to. So then you have the Mile IQ information, then I have the client, and I have where we're going, which we need anyway. So if you can do those two things, it's going to get you 99% there to comply. And I know it's a little more work, but it's just such a big problem. If they send you a letter, they can add it back so easily, and I'm trying to circumvent that. So, right, simply add your destination or destinations to your calendar entry with the client name. So we have your calendar to rebuild things later. You want to print out your monthly calendar detail and save it locally in your office or PDF it. Now this is very important. I call my clients on New Year's Day at 6 a.m. And what you want to do is you want to take a picture of their odometer. Now, why is that? If you go back to my prior screen, the main part of mileage deduction of all of it is total miles for the year. Nobody has that. That's a big problem. Even if you have all of your mile IQ, you have your calendar correct, but you don't have the total miles, they can then disregard it. So if nothing else, this shows an amount of mileage. So get up on New Year's Day, take a picture of all cars used for business, and print it out and put in a folder. So that gives an exact mileage for the year, which the IRS loves. And again, it's not that much work. Everything I'm asking you to do for yourself is a little bit more work, maybe, but it's important information to keep because it could be thousands of dollars in the long run, that you're going to lose in tax, interest, and penalties if you don't do it. So, any questions? Of course, I'm always here. Oh, and I send out every year. I send out a blog post a few days before this that reminds you. So if you get on my blog listing, you'll get that nice big email about taking a picture of your odometer. Business meals. Now, business meals used to be 50% deductible, and now they're 100% deductible. But a business meal is where we're going out with a client, buying them lunch when we're going on open houses. But if you buy food for an open house, that's marketing expense. It's not a meal. So it's still deductible 100%, but you want to put that to marketing. So marketing is not really a meal. So if you want to put things in the right category, that's why I give you all the categories I give in my blog post because I want you to be as diverse in as many categories as possible. The smaller the numbers in the long run, the better. Remember, it's no longer 50%. Now, entertainment. Entertainment is no longer deductible at all. That's if you buy tickets or box seats or hotel rooms, things like that. They used to be deductible, but it's no longer deductible. A lot of realtors, I don't use this category much, and so, but it's important to remember when thinking about a lot of people suddenly come upon something they want to do for a good client, and they're thinking of the old law, and they think they can deduct it. I see it all the time with new clients. So just know what you can and can't deduct. And if there's something in the middle, always just text me and I'll let you know. Now, everyone in the audience, I can't see you, but raise your hand if you give gifts in business. And I say you don't give a gift. Remember, a gift, even per the IRS rules, is something that you give to someone out of the kindness of your heart, like my grandkids on Christmas morning to see the joy in their hearts and their faces. And I would give it no matter what. But people usually are giving closing gifts, for example. But if they knew that they wouldn't get business from it, definitely they wouldn't do it. So it's really marketing. So we don't want to put a gift down because it's not a gift. It's so put it to marketing expense because a gift is limited to $25 per person, but they're not a gift. You're not giving a gift at that point. It's a marketing expense unless you would give the gift anyway. But I don't show gifts on my tax returns. Again, it's advertising or marketing. Let's talk about your retirement a little bit. A lot of self-employed people like us, we don't know that we can put away for retirement, like we talked about earlier in my new tax update for 2024, that self you can put away for your retirement and deduct it 100%. So, for example, uh, let's say I calculate that you can do a $10,000 SEP IRA, you're in a 25% bracket, that only costs you $7,500 because I'm deducting it. So can you imagine you put away 10,000, it only costs you 7,500. That's an instant 25% investment return, then it grows tax free. So make sure when you do your tax, like when I do a tax return for self-employed people, I include a detailed analysis of what your SEP IRA might be. So you know what the tax benefit is. So make sure whoever's doing your taxes does that for you to give you the option. You don't have to do it. It's good to know. And plus, you also could be putting money away. So if you wanted to do a 2025 SEP IRA come next year, you could be depositing every month on a savings plan. You don't have to wait till next year. And of course, I can answer any questions about that. So please consider this because it's you're getting a full deduction on money you're keeping and not spending. So it's still an amazing deduction. Now, let's talk about itemized versus standard. Now, this is important. This has nothing to do with the business deductions in your business. This has to do with your personal itemized deductions. Now, it's the Schedule A form. A lot of you know it is used for itemized deductions. If your itemized deductions are greater than your standard deduction, then you take that higher figure. For example, medical, taxes, mortgage interest, charity, those are normal things that we can accumulate on a Schedule A to see if it exceeds what's called the standard deduction. And hopefully it does because the more you can exceed the standard, the more tax you're saving. So make sure your CPA calculates which is best.
We got another question coming in. What happens if you put too much in your SCP?
Then they just have to refund it or move it to the next year.
Thank you.
That's all you do. They can move it to the next year. It's not taxable or anything usually at all if you do it in time, but that happens all the time. Because if you're making monthly deposits or quarterly deposits, which is a great idea, then you can't know if you're right because we calculate the SEP IRA based on your net Schedule C, and so we don't know that until April or February. So yeah, you just have to tell the broker to move it into the new year to roll it over as a credit to your next year's SEP IRA.
Got another question coming in. If you're working at home and don't have time to make a meal at home for lunch, but you run out to grab a meal, would that count as a business meal?
Only if you're with a client and it can't be an invisible one.
Thank you.
But everyone should be doing at least a dinner a week that's business related. That's pretty normal to tell everybody. Now, charitable deductions. This is one a lot of people are afraid of these, but a charitable deduction is an itemized deduction, like we talked about a moment ago. And so, though these can put you over the top of going over your standard deduction. Everyone should have non-cash charity as well as cash charity every year. I have good blog posts about this. What do people take? Because you can't get a receipt. A lot of the fear comes from years ago. There was a lot of talk that you need a receipt for everything, which is not true, because you can't get a receipt. Like when I give all that money to Salvation Army buckets, I can't get a receipt. The bucket's really heavy when I'm done, so I give a lot of quarters. But so don't be afraid to take these because everyone's very generous in these states, and it could put you over the standard deduction. So if you're having someone else do your tax return, always ask them, well, did I use the standard or itemized when you see the draft of your return? If they say standard, say how much charity did I need to put me over the top? Make sure they give you that option, both cash and non-cash. Like I just said, these may allow you to itemize your deductions instead of standard deduction. Again, every dollar over the standard saves you a lot of money. So we want to make sure we look at that, especially for just W-2 people, not even self-employed people. If you have friends who are W-2s, there's not a lot they can do except in the itemized deduction area. Now, years ago, if you remember some of us, there was a state and local income tax deduction that was limited, right? So years ago on the itemized deduction side, the federal government limited the tax section to 10,000, which is incredibly low for high tax states like California, Jersey, and New York. And so this was a negative for the real estate industry because some of the pundits kept saying, oh, the reason why we're buying a house and paying more money than renting is because we get to take the real estate tax deduction. But that's gone now or cut off. So it's been negative for home ownership in high tax states like New Jersey for that reason. But I predict President Trump will make them unlimited again for 25. So this gives realtors back this great selling point for home ownership again. Because remember, that's one of the reasons why they made all this deductible decades ago was to get the housing boom going. They said, oh, you're going to pay more than renting, but you get to deduct all these things on your tax return. So that's good to know, and I'll let everybody know if you're my blog subscribers when I will know when I see that that's happening.
What's the amount of the standard deduction?
Let's see. For 24, married's about 26,000, singles half that.
Thank you. I don't see a follow-up on that one.
Oh yeah, exactly. Right. So it's going to be 29,200 and 14,600 for single. That's what's proposed for 24 now. But it's not finalized. But that's like I said that then and when Trump got in, he doubled it. He used to be half that, but we still have so much that we pay in tax and different things we can. All right, there I'm back. Can you hear me?
Yeah, we can hear you.
Great. This is very important now about realtors. The investment property market is ignored as an investment strategy by many realtors. It's prone to vague fears and misunderstandings. So we have forever home market area here, right? Let's say you're up in there's a little quadrant. I could move this oval anywhere down to Monmouth, Ocean County, Burlington, Camden, and that's usually it's two or three counties that realtors focus on. And so in Monmouth and Ocean County, everyone knows the inventory is huge here, right? And all the sellers are so easy to get them to reduce their price. It's easy to sell here, and of course not. So it's the dog eat dog here. So I would rather have this. I'd rather have, if you think about invest property strategies, you have the really from 50 miles outside of Jersey border we could be selling. There's so much property in Pennsylvania and northwestern New Jersey that are primed to buy rental property, townhouses and condos and mother daughters, for example. And so realtors don't look at this. They're focusing on forever homes, but the market is so tight and people are starving. So you really want to consider doing investment properties and look at properties that way. Even your current listing. So anybody have any questions about that?
I'm not seeing any coming yet, but if they do, I'll definitely let you know.
All right. Well, I hope everyone's enjoying this so far. I'm trying not to be too dry about it, but it's important. So 1031 exchange is very important for realtors to understand, and I try to simplify it to make it under. So this is a very detailed discussion usually, and everyone, including me, can get confused. So when can we do a 1031 exchange? When to think about it? When to suggest it? If a client doesn't need the proceeds from the sale of an investment property, consider a 1031. So if a client has taken proceeds from a sale, they can't do it, or if they when they sit down, any money they take is going to be taxable. This is why I want you to give this as an option to your clients because I want them to buy another property from you. If, like, for example, people move all the time, they have properties in New Jersey. Well, why don't we sell the Jersey City commercial building and roll the gain into a property in Florida? So this is it's a good tax savings for them, but it's a way for you to make more commission. We all should be thinking about selling more properties, right? But this is not for residences or second homes, only for properties that have been rented commercial or for, for like single family homes, for example. Now, what does a 1031 do? It allows you to defer paying the gain on the sale of a rental property by reducing the basis of a new property. And I'll show you how that works.
Is the 1031, is it not limited by the same state? Can it be anywhere in the USA?
Anywhere in the world. It's just got to be a similar property. Just has to be a rental for the most part.
Awesome. Thank you.
Right? Why keep it in mind? Well, we want more non-forever home investment property sales. Often an ignored strategy. Very important. I do so much investment property work, and it's just amazing that realtors don't know a lot about it. But it's a whole profit center. Like if I got my real estate license, that's all I would do all day long is investment properties. This is a good example of how this basically works. So let's look at the left side of the screen first. So we have a property we just sold for $1 million. We purchased it for 400,000, and we had depreciation for 200,000. So that leaves our basis at 200,000. 400 minus 200. We take off the depreciation. Our basis is 200,000. Our gains 800,000. Hopefully everyone understands that. So we have 800,000 now. If we don't do a 1031, we have to pay tax on the 800,000, but we're going to buy something of equal or greater value. So the new rental on the right side, we buy it for 2 million. Now we have that deferred gain comes over to the right column now. Now our new basis for depreciation is 1,000,002. So you see how that makes sense. We didn't pay tax on it, but that's rolling that gain over by reducing the basis. So if the next day I sold that property for 2 million, I'm gonna have an $80,000 gain. So you have this hopscotching or domino effect of basis being rolled over and reduced. Anybody have any question about that?
I'm not seeing any yet.
Well, I'm very clear. That's great. Remember, if you take proceeds at closing, all of the proceeds, no 1031 is possible. You can do a partial. let's go to our example here. Let's say my new price was 900,000, and I'm going to take 100,000 back. Then I would pay a prorated gain just on the cash I took. That happens all the time. You can't always get an equal or greater value of the new house or new building. So remember, any cash that's taken, a dollar or the full proceeds is going to be taxable. This is a perfect time for your clients to divest the gains and diversifying the hard assets. Any client that we have that is all in stocks and bonds, they're very much at risk because they're only in one asset class. So we want them to divest some of that. Want to divest some of that stock and bond portfolio and buy rental real estate, which we know is much safer, much better for the future from all perspectives. Rental real estate always beats the market in the long run, especially from a cash flow perspective, right? So they're not diversified enough. So we want to do emails to the clients, say, the market's been up, and would you like to have a consultation about diversifying and divesting some of that to get into the much better rental real estate market? And you'll be surprised how many people will respond to you. So what's good about that is, so they sell $1 million of stocks and they become cash buyers, and they get it. That's giving them an advantage over mortgage holders. So it's great for you. It's great for them, for the sellers of the properties, because they have some ready to close that moment. So how many of you have emailed your existing residential clients with investment property opportunities? It's a good question, because I get inundated with emails about listings, and so that sort of becomes a blur. But why don't we try to do an email just for investment property opportunities? Now that's a whole different sale. It's forever homes is one thing, but investors are different. So you want to learn about that. We do a lot of training on that. How many of you have active listings and you've analyzed them for investability? So if you have a listing that's not moving, have you also done a whole different write-up and investability analysis to go to the investment community? Because people walk in my office, Chris, I inherited 400,000. What do I do? And I'd like to call realtors and say, listen, someone has 400,000. Can you send me your write-up on an investment property opportunity? Remember, it's the same house, same property, but it's a totally different sale. So if you do have listings that aren't moving somewhere, which could be, you want to say, well, it's possible we should do an investability analysis on them so we can get it out to the market. There are some realtors who do this well, but very few. I'm just saying, I want to have my hand out in every different profit center I can get in my work. And I think everyone should become more conversant in understanding it, analyzing this, doing emails that relate to this, because there's people with a lot of money that move from New York and down to the shore, and they sold their brownstones for 5 million, and they bought a house for two, but they still have 3 million in cash sitting there, and that should go into your pockets. Do them a favor and sell them a rental property. Hope you found this worthwhile. Email me your contact info and subscribe to my blog and any questions.
All right. Well, thank you. Let me pull myself back up. Anyone have any questions for Chris? I know we had a couple coming through, but I'm checking. Make sure you're using that question chat with it's the speech bubble with that question mark inside if you've got any questions or comments, and I'll read them out. But I'm not seeing any coming through yet. I'm gonna give it a second and see if anyone's got anything, but if not, I think that might be it.
Can I see everyone or no?
I I don't think so. Someone did say awesome. This was awesome. Thank you. Oh, what info is required for meal deductions?
I just need the receipt.
Oh, I think you might have frozen. Not sure if he's frozen for anyone else.
Can you hear me still?
Oh, there you go. Yeah, you cut out right at the beginning of that answer. I'm so
Yeah,
sorry.
we just want to write it down on the receipt, but also put it on your calendar. Went to dinner with Chris Whalen. He had the prime rib, and and we went to this steakhouse. So it's always good to put on your calendar as well as have the receipt. So if you, that's what I always do. So that's my master record to print out. All my meals are going to be there, and the receipts just are in a folder.
Any more info on property investability analysis?
Sure. Well, the main part of analyzing a property is we need to know the fair market value rent. Just that's where everything stems from. So we need to. I have a detailed spreadsheet I could go over with you. I can't do it now; it'd be too long. But we need to know the fair market value rent. We're going to need to know all the possible expenses. We're going to need to know what kind of mortgage you're going to have, what kind of money you could put down. Usually, they want at least a 30% or a third down on investment properties. And so we could come up with I could have a condo in two different townships right across the street, and the whole market is different, the taxes are different. So it's just a matter of coming up with what's the fair market value rent, doing a P&L, an income statement of all the expenses and the possible income, and that's the beginning to see, well, what's my net. There's two different things. We need net cash flow out the door, but also what's my tax income, because those are two different things. So, like for example, the mortgage, the principal and interest is part of the cash flow, but only the interest is part of the tax return. Remember that. So I can't deduct the full mortgage. So if you have any listings you'd like to go over together, I'd love to help you with that. So we can brainstorm it together in a Zoom or in my office, and I could show you what I would do.
Awesome, thank you. We have someone else that says, if I'm a new agent and have no income my first year, can I still take deductions?
100%. You're
Perfect.
actively you're actively in business. You're actively in business, so that happens all the time with startups. You're a startup.
If I'm a brand new realtor, so I'm doing my taxes for the first time, do all accountants know the ins and outs of real estate?
I would say no.
So, and then do I need an EIN to open a separate business checking account?
No. Again, if you're going to just in your name as a sole proprietor, just don't even tell the bank it's for business. Say it's a personal checking account for my own use. Because if you say it's a business account, they're going to want to charge extra fees for no reason. Just have a Chase account or a TD account. Could be the same bank you're with right now, and just use that for business purposes. It's going to make, and also if you hire me, I can give you a really good spreadsheet that will keep your balance. It'll keep your income statement, so you can reconcile easily at the end of it shows reconcile easily at the end of the month.
Awesome. Well, thank you. I'm checking to see. I don't think I have any other comments. I'm going to give it another couple of seconds because I know there's a little bit of a delay. But thank you in advance for this excellent seminar. I don't know about anyone else in the class, but I've learned a lot as someone who doesn't do taxes very well. So this has been excellent. Oh, what are you? Oh, someone wanted to ask. So that question, I would say direct to Chris outside of here, just because I don't want to get into those types of personals. Oh, someone did want to know if they could get your email address again. That was at the
I'm
beginning of
just
the class.
I'm typing it. I'm typing it in right now in the chat.
Okay, perfect.
Everyone should email me at least, or let me just put in the chat. I'm going to
Mhm.
give you that expense category. It's a really, really, really good thing to have.
Oh,
Suggested expense.
you sent that just to me, so I'm gonna send that to everyone.
Oh, I do. Only
Oh,
I
no
see what I
worries.
did.
I got it. No worries. You're good. So, well, in the bottom of that chat, it should say to organizers. If you click that, it'll then move to everyone, I believe. If
No,
y'all
it's
check
not
the
giving me
chat,
that.
yeah, for everyone else, if you check the chat, you should see a little number up in there. That will be. Nope. Give me 1 second. That you should now see a bunch of messages coming through. From me, that's everything that Chris just sent over. So if you're in need of that email address or if you want that extra information, it should be in the chat. You will all be getting a survey afterwards, so definitely keep an eye out for that. And I believe the additional information will also be available. I do see someone raising their hand. Can you put that in the question box for us? It's the question, speech bubble with the question mark inside of it, and then we can answer that. And if that's the only other question, then I think we're good to wrap up. I'm gonna see if that question comes in now.
Great.
hmm Oh, someone wanted to know if you were still taking clients or if you're taking new clients.
up until the end of the month.
Perfect. Whereas the chat, so the chat would be the two speech bubbles, one overlapping the other. There should be a couple of numbers in there. I'm going to give y'all a couple of minutes just to go in there and grab that. And I'll say thank you again, Chris, for an excellent class. Thank you for sharing all this wealth of information. I know everyone else has been saying thank you. So with that, I'm not seeing any other questions coming in. So I'm going to give it just another minute and then I'm going to wrap everything up here. Everyone else, if you have no other questions, you're more than welcome to head out. Thank you again. I hope you all enjoy the rest of your Thursday. Have a great weekend and stay warm because it's cold over here. I don't know about y'all, but it's cold here. But all right, I think that's it. So Chris, you have a great day. Everyone else, y'all have a good one and we'll all see you soon. Thanks. Bye.
Thank you, everybody.